Hello, my name is Katie Wantoch, Agriculture Agent for UW-Madison Division of Extension in Dunn County. Today, we're going to be talking about working with your lender. Low commodity prices and increasing debt levels are placing some farmers in serious financial distress. This video series will discuss how you can work with your lender, from learning about the 6 C's of credit that a lender may consider during your loan application, to identifying steps to complete your loan application and establish a relationship with your lender. A lender's primary interest is in whether or not you're likely to fulfill the requirements of a credit agreement. When a creditor lends you money, he or she does it with the expectation of earning a profit, which is unlikely to happen if there's a good possibility that you'll default on the loan. The lender will be more willing to act favorably on your loan request if you can be viewed as someone who will make a full and timely repayment. Because they're human as well as individuals, lenders vary in their ways of evaluating loan applications. A single lender may use different methods to evaluate different applicants. Some lenders may emphasize personal qualities that were impressive from a face-to-face interview, along with opinions from references. Others will strictly follow a list of established guidelines related to income, length of employment, past payments, and current debts, and the like. Most lenders, however, take a more intermediate approach, evaluating a loan applicant on the basis of both subjective and objective criteria. Lenders analyze the creditworthiness of a borrower using the 6 C's of credit: character, credit, capacity, capital, conditions, and collateral. Each of these criteria helps the lender to determine the overall risk of the loan. While each of the 6 C's is evaluated, none of them on their own will prevent or ensure you receive a loan. There is rarely an automatic formula or guaranteed percentages that are used with these 6 C's. They are only a variety of factors that lenders will use to determine how risky you are as a borrower. The first C of credit is character. This is highly subjective evaluation of your personal and business history. Lenders want to believe that you are a reliable person who can be depended on to repay the loan. This may include things like your appearance, reputation, and overall ability to manage a farm. Lenders want to do business with people who are highly reputable, honest, and fair. The way you treat employees and customers, the way you take on responsibility, your timeliness in fulfilling obligations will tell a lender how you would react during a crisis. The knowledge, skills, and abilities of the owners or managers are crucial components of character. This would include management of skills, risk management, and financial management. The second C is credit. Credit history tells a lender how much credit experience you have, what are your current obligations, and how have you paid your previous obligations. Lenders have different thresholds for what they consider to be a good credit score. You can receive a free personal credit report at www.annualcreditreport.com. This right is guaranteed by federal law. You may receive a free credit report every 12 months from the credit reporting companies Equifax, Experian, and TransUnion. Lenders may also review a Dun & Bradstreet report for your business, financial, and trade information. These reports may include a variety of information on the business, including timeliness of payments that you have made on previous loans. The third C of credit is capacity. Capacity is your ability to repay debt obligations to the lender. The lender needs to know how you will repay the funds before they will approve your loan. Capacity is evaluated by these components: cash flow, level of risk management, and sources of repayment. Do you have enough cash flow? Your income statement will provide the information of income generated and expenses paid to operate your business. Capacity can be evaluated by level of risk management. What type of risk management are you utilizing in your operation? This can be a function of how you manage risk by purchasing insurance policies, such as property, crop, or life insurance policies. Are you taking advantage of forward contracting or hedging to guarantee price received is over your cost of production? Are you prepaying or completing early purchases to take advantage of the cash discounts? Capacity can be evaluated by sources of repayment. Do you have other income sources that may support your operation during a crisis, such as an off-farm job or rental income from wooded land or residential property? The income of a spouse employed off the farm is commonly considered under capacity. The fourth C of credit is capital. An owner must have their own funds invested in the operation before a lender is willing to consider their application. Capital is referred to as that owner's personal investment in their business, which could be lost if the business fails. There is no fixed amount or percentage that you must have invested before you are eligible for a loan. However, owner's equity is a cushion for adversity. So is 35% an appropriate minimum, or should it be 50%? A lender will not fund 100% of your business, so you need to have some skin in the game. The higher the risk, the bigger the cushion that the lender would like to see to finance a project. What was the source of equity generated? Was the equity earned, inherited, inflation, or appreciation adjusted? This is important to know and be able to explain to the lender. Take a look at the owner equity trend over a 5-year time frame. The more that you are personally contributing to the operation, the less risk that the bank would be taking on providing you with the loan. Lenders want a business owner to also make a financial commitment and put themselves at risk for the business. The fifth C of credit is condition. Lenders may be interested in what your plans are for using the money. They may want to see the property or equipment to determine its value and what condition it's in. Lenders may require an appraisal be done to determine the condition of property or equipment. They may want to see farm production reports, such as crop yields, DHIA milk reports, etc. Other conditional factors may play a role too. What is the current state of the economy in the area? Will the borrower be able to succeed in that economic environment? What is the general economic climate like? If the industry that you are in is declining and the economy is uncertain, there is more of a chance that the loan may not be approved. The purpose of the loan is important. If you are seeking funds to expand your market or acquire new assets to improve efficiencies, you may have a higher chance of approval. Complete a SWOT analysis by defining your internal strengths and weaknesses, external opportunities and threats, to see what you might be facing in the marketplace. The final C of credit is collateral. This is a little different from capital, but it works in the same manner. Lenders also want to make sure the borrower is taking a risk, so by pledging a guaranteed asset, the lender understands you're serious about repaying your loan. You may prepare a report that lists all of the items you own, such as crops, livestock, machinery, or other business assets. The lender will use this for the loan application. You may want to make a few notes when compiling your list. Real estate? Is it owned or rented or leased? Is there a written lease arrangement or is it verbal? Do you have a land contract? Machinery. Is it owned or leased? Are there existing liens or loans on pieces through dealership or other banks? Is it owned by other parties and stored at your farm? Livestock. Is it commingled or do you own the animals fully? What is the breeding plan or plan to market those animals in the next year? Crop. Are they currently growing or is the crop stored? Who owns the crop? Collateral is also a secondary source of repayment during liquidation or sale of property. Lenders prefer that you repay the loan using cash flow from the business. However, collateral can be sold to repay the loan if borrower defaults. Personal guarantees of owners of the business or a government guarantee may also be needed to support the loan application. When an owner uses their own personal assets as a guarantee on a business loan, that means the lender can sell those personal items to satisfy any outstanding amount that the business has not repaid.